Welcome to Taking Stock for the week ending the 6th of August 2021, where today I have the pleasure of welcoming Tim Lincoln, our Managing Director and Chief Investment Officer, and joining me, Kien, Trinh, Head of Research, to stream to you all things share market. Welcome, Tim.
Yeah, hi Kien, how are you? And great to be here, and great to be here with all of our members and investors who are tuning into this recording as well. And most of Australia's in lockdown as we are here in Victoria. But Kien, I don't mind lockdown, even though we're really lucky because of obviously the industry that we're in, and our hearts and thoughts go out to all of those who aren't in industries like the financial services where they're doing it a lot tougher, especially in hospitality and tourism and the like. But lockdown allows us, doesn't it, to really focus in on constant innovation and how we can improve Stock Doctor and our managed funds going forward, or constantly enhance. And we've certainly been doing that. So lockdown allows us to really focus in. But yeah, great to be here with you all.
Yeah, thanks, Tim. And despite the risks of lockdown, the market, has been quite resilient, Tim, with the month of July now behind us as well. Let's quickly review the performance of our star stocks to date. Both our star growth stocks and star income stocks have had a positive month as well. And it would have been even better without some of those fund managers like Platinum Asset Management and Magellan Financial Group, which have experienced heightened active risks around Chinese market exposure following the regulatory crackdown by the government. And we highlighted this risk last week in our Taking Stock video. So be careful holding on to these exposures as they head into the results. Meanwhile, borderline star growth stocks, they recovered well last month on the back of strong performances from the iron ore stocks, BHP, Rio, Fortescue, and the ongoing takeover activity with Rife and Iris as well.
Yeah, another really solid month, wasn't it, Kien, for star stocks and the market. And that includes global markets that keep bounding ahead, don't they, in this low interest rate environment, which is terrific for our members. And I'm obviously really proud to be able to deliver such strong results to our Stock Doctor members. And after all, that's why they subscribe, isn't it? To get good, solid returns over the long term relative to their objectives, whether it be for growth or income, but also they want to access all of the value-added features in Stock Doctor too, and be able to call on their relationship manager or you and your analyst, Kien, to have a chat, and that obviously relates to our dedication to high service levels and our education there to make sure that investors not only learn the Stock Doctor platform, but they learn the importance of all of the philosophies that we embrace around selecting quality businesses. But it's always been my goal to try to deliver double-digit returns with our star stocks and to Stock Doctor members, and that'll obviously allow members to get rich slowly and embrace the power of compounding over the long term. And we won't be tempted to get sucked into these speculative trades like Afterpay, and more on that crazy story later. But it's the easy money that's really driving the market at the moment, being made available through stimulus. And that isn't sustainable as stimulus wind downs start to take place over the ensuing months. But what we'll always stick with is our quantitative-based methodology, and that's a numbers-based methodology that allows us to select for Stock Doctor members high-quality, financially healthy businesses under Golden Rule 1 that are profitable, have manageable debt levels and strong cash flow, and that under Golden Rule 2 have the growth and income metrics that allow members to be very confident about the future prospects of the businesses that they own. And if we all construct portfolios and manage portfolios of around 15 stocks that meet our growth and income objectives, not only should members prosper into the future, but also they'll enjoy a good night's sleep knowing that the companies they invest in are quality and not highly speculative, high-risk companies that seem to be doing so well at the moment. So yes, we keep blocking out the noise, Kien. Back to one of our mantras, block out all of the macroeconomic noise, make hay while the sun's shining in this historically low interest rate environment that's going to be here for many months, if not many years to come.
Yeah, that's right, Tim. And you've spoken about the easy money. And there are now signs that this period of easy money policy is coming to an end. And that's contrary to market expectations. The RBA has confirmed that they plan to gradually unwind their bond buying stimulus program from mid-September, reducing their purchases by 20%. And as you said, Tim, they've kept interest rates on hold at 0.1% and upgraded their economic growth forecast for 2022 from 3.5% to 4%. So what does this all mean, though? It effectively means that the Australian market should continue to rise in the coming year, but there will be a normalisation in the market fundamentals where the driver of the market rally will come from those companies, as you said, Tim, with very strong balance sheet and superior earnings and profit metrics as well. So the start of this reporting season has seen some key themes emerge from our star stocks, and results have been better than expected, but companies have been reluctant to provide the outlook guidance due to the uncertainty around, as you mentioned, Tim, the statewide lockdowns and the vaccine rollout as well. And it's also more difficult for companies to generate earnings growth from a high base, especially across those star retailers where there is evidence of a slowdown in retail turnover. Retailers like Nick Scali, for instance, JB Hi-Fi and Adairs, they are benefiting from this sales boom as consumers stay at home and redirect their travel expenditure to furniture and home appliances. And the discounting that's been used, they've been able to cut that back. And this has allowed net profit margins to improve as well. So we saw same-store sales growth for Nick Scali rise by about 34% for the year, with their online sales now representing 7% of their total earnings. However, the outlook appears to be softening, with their order pipeline down about 27% from a year ago. So with the company now sitting on a truckload of cash and earnings expected to fall by about 30% this year, Nick Scali is now looking for acquisitions to drive growth. And the potential acquisition of this plush sofas is a perfect example of that. Currently, the stock is on a gross dividend yield of about 6.8%, with the ex-dividend date about 2 months away as well. And despite the slowdown in retail sales, one bright spot in this space is the strong demand for new vehicles, which was up about 16% in July, driven by the government's instant write-off benefit. And this in turn is driving solid updates for our star stocks such as ArbCorp. They are the manufacturer of four-wheel drive parts, and GUD Holdings, which also sell car parts as well. But with regards to GUD Holdings, the closure of its physical stores from state lockdowns has led to increased uncertainty in the near term, although analysts still anticipate earnings growth to be 10%. GUD is currently on a gross dividend yield of 6.7%, and they are expected to go ex-dividend on the 19th of August. So, Tim, what's the fund strategy behind these stocks?
Our strategy is pretty simple, Kien. If you present retailers to us as star growth stocks or star income stocks, then we, as long as liquidity's there, we invest in them. As simple as that. So we're really disciplined around that, Kien. With our Lincoln Australian Growth Fund, it's a pretty much an equal weight portfolio of liquid star growth stocks, of which the retailers and the names that you've just mentioned occupy a reasonable percentage of the portfolio right now. That's probably where our highest weighting is towards the retail sector, as we just roll with the numbers that are produced in the star stock evolution. And the star income stock, if they're also star income stock, then yeah, it's pretty much an equal weight approach there, but we'll obviously increase our exposure to stocks that are going ex-dividend in the quarters of distribution to investors. So yeah, we're really disciplined with that, aren't we, Kien? We construct our portfolios around the liquid universe of star stocks. It doesn't matter what sector they're from, but where the concentration of sectors might be is a strong indication of where the economic strength is at that particular point in time.
Yeah, that's right, Tim. And you talk about stocks going ex-dividend and just holding onto that exposure. And we understand that Rio Tinto, for instance, and iron ore miners like Fortescue and BHP, they are paying quite attractive gross dividend yields as well, between 10 and 20%. So the issue with a lot of these stocks, and we are keeping an eye on them, is that they've done exceptionally well, but they are reporting slower earnings growth this year as well. And that's due to some of these active risks we're seeing in the marketplace. So we are closely monitoring those active risks, especially around the unwinding of iron ore prices due to declining Chinese manufacturing activity. And that's amid a crackdown from Chinese authorities citing environmental concerns. And also you've got the recent China lockdowns on the spread of the Delta COVID strain as well, also expected to slow manufacturing activity as well. So again, we are mindful that, with Rio Tinto expected to go ex-dividend next week on the 12th of August, we are mindful that some of these iron ore stocks could potentially, that could weigh on the share price of these miners once they come dividend. But let's turn our attention to a few of our other star stocks results over the week. We had Credit Corp, and they are a purchaser, reseller of bad debts and provider of consumer loans. They released results towards the top end of their guidance range with net profit margins. They rose on the back of the higher contribution from the US segment. Now, the share price reaction was quite muted on the day, and that was due to management's conservative outlook guidance for low single-digit growth, which was below market expectations of around 10%. But despite this, we've retained the stock as a star growth stock and initiated Credit Corp as a star income stock because we believe that the company has a favourable market position in Australia, a growing presence in the US, and a very strong balance sheet, which should support their rising dividend profile. The gross dividend yield on Credit Corp is currently around 3.5%, but the stock is also expected to go ex-dividend at the end of August.
Wonderful success story, Credit Corp, isn't it, Kien? It's been one of our star growth stocks, in and out a few times over the last 25 years, but the time that Stock Doctor's been available, it has occupied a place as one of our star growth stocks, and obviously investors in Credit Corp have done incredibly well. It also comes in and out from time to time as a star income stock, and we'll now have to consider including Credit Corp back into our Lincoln Australian Income Fund now that it has come back in as a star income stock. However, with $4 million traded every day, we're mindful of liquidity. Under Golden Rule 6, we generally need at times between $10 and $15 million commitment to a particular stock in the Lincoln Australian Income Fund. So just mindful of liquidity requirements. But Thomas Bareji, what an amazing CEO he's been for this particular business. Been at the helm now for a long time. Obviously knows his craft, and with the penetration now into the US, perhaps Credit Corp is going to keep on going from strength to strength and really look after our Stock Doctor members and managed fund investors beautifully.
That's right, Tim. And another company that's done exceptionally well for us is Pinnacle Investment Management, which is a fund of funds investment group, meaning they hold ownership stakes in other fund managers, also known as affiliates. Now, the strong price performance has been attributed to the exposure to those strong performing fund managers. For example, it has a 50% stake in Hyperion, a growth style fund manager, which has done exceptionally well because of its investments in Afterpay and Tesla. And with a cash war chest of around 96 million, there are options for the company to generate growth via acquisitions. So the market is currently anticipating double-digit earnings growth for the coming year for Pinnacle, although the dividend yield is looking now less attractive following its strong share price appreciation.
Yeah, it's an interesting business model, isn't it, Kien, where they really do look after a lot of the distribution for fund managers while taking an ownership position in the fund managers, as you mentioned as well. I'm not sure about Hyperion's investment in Afterpay especially, but they've obviously done incredibly well there. But I just say that with a little bit of tongue in cheek, because Hyperion are very good wealth managers as well. But, obviously too, Pinnacle earn their fees from the profits that are made through performance fees that these fund managers generate. And in this booming market, obviously they're doing well. But the distribution side of the business is really interesting. It's a really sound business model because a lot of fund managers do need distribution or a sales arm. They're good at managing money, but are they necessarily that great at promoting their businesses and selling the value of what they do? So that's where Pinnacle step in. And Ian McCoon, he holds a significant stake in the business. So under Golden Rule 7, we love to see that skin in the game. Although we did sell stock in February, that's okay. We understand the reasons for that. If they're adding value and wealth to shareholders, happy for them to take a little bit for themselves or for whatever they might want to use it for. But obviously, a good leader, good business model, and going from strength to strength in this environment.
Yeah, that's right, Tim. And also just released as well, REA Group, the online property classifieds business, they reported an 18% rise in earnings. But they did warn of lower listing volumes at the start of this financial year due to those lockdowns. But we'll be monitoring the impact of this and the impact of this on the outlook, with earnings growth expected to be around 20%. Also, ResMed, a company that treats breathing and sleeping problems, they've released their fourth quarter result, which was above management expectations, and that was due to a competitor product recall, allowing the company to expand its market position. And earnings growth is expected to be in the double digits in the coming year, with this theme of competitor supply issues also expected to continue as well. Okay, now moving on to the corporate calendar. With the reporting season underway, the star companies to announce results next week include Suncorp, you've got Commonwealth Bank, so that'll be interesting whether they release a buyback or not, Baby Bunting, Charter Hall Long Whale REIT, Arena REIT, Telstra, and also Charter Hall Social Infrastructure as well. James Hardie will also be releasing its quarterly result, and of course Rio goes ex-dividend as well. As for the trend-sensitive investors, Monadelphous and Technology One, they both turned bullish on the SD Max. Meanwhile, there was no observed changes to the SD30 TSR, which is the 30% stop loss. For Under the Microscope this week, we draw your attention towards the speculative nature of the market, with a case study on US payments business Square's acquisition of Afterpay, a buy now, pay later company. Tim, you've been quite vocal about how the market has been driven by speculation rather than the fundamentals. And this, no doubt, is a bit of icing on the cake, isn't it?
Well, I don't know if it's the icing on the cake, Kien, or the start of something even that reeks of more higher levels of speculation or not, because 39 billion acquisition for a company that's financially unhealthy and hasn't got a history of profitability is just bewildering. More on that in a moment, but I think, Square itself as a business, I've had a little bit of a look at their hardware, and especially their point of sale hardware that's used in cafes and stores and the like. It looks pretty good. It's very innovative and new. So they've obviously done a lot of due diligence in regard to bolt-on businesses like Afterpay, but 39 bill for a company that hasn't made a profit, that's absolutely bizarre and crazy, Kien.
Yeah, incredible, Tim. And Square was founded in 2009 by Jack Dorsey, who also is the founder of Twitter as well. But when we assess the company achieved a satisfactory financial health rating over the last quarter, which is an improvement on their early warning the quarter before. But despite this, Tim, this deal really reflects the amount of speculation in the marketplace without really considerations on the active risks of the two businesses. And let's talk about those risks for a lot of our investors as well, just so that they can understand it. But firstly, Square derives 70% of its profits from Bitcoin transactions, with the company not only investing in the digital currency, but also profits from letting its Cash App users buy and sell Bitcoin. And this makes their earnings from period to period highly volatile, Tim. And secondly, you've got this all script offer from Square, which allows the company to take advantage of its recent share price run, which also adds an element of valuation risk to Afterpay shareholders once they receive shares in Square as well. And of course, the deal values, as you said, Tim, Afterpay at 39 billion or 42 times revenue. So it's valued on a revenue multiple because the company's not generating any profits since its listing in 2017. So as a result of this, the company, that is Afterpay, is rated distress on our financial health model as well. So incredible there. And the deal is also masked by the fact that Afterpay reported operating performance, which was around 10% below market expectations. with sales over the half declining by about 4.2%. So there is a slowdown in sales growth here, and that's due to increasing competition in this space from Apple, PayPal, and also even Commonwealth Bank coming in to threaten their and to hurt their merchant fees and market share as well. And finally, when you've got Afterpay, which represents 23% of the total market cap of Square, and when you've got this merged entity and Afterpay being in distressed financial health, this may tip the merged entity into a precarious financial position unless, those synergies are recognized pretty soon.
It's nuts, isn't it, Kien? It's some of the numbers that you've just spoken through there. They're crazy. We're traditional fundamentalists, and we like to run businesses based on normal type fundamentals of, profitability, manageable debt levels, good strong cash flow, pay reasonable multiples for acquisitions if there's a history there that you can calculate a reasonable multiple on. But generally calculated on profitability. But 42 times revenue and future revenue, that is. And, 70% of Square's profitability has come from Bitcoin trades. And a lot of the active risks that you've just mentioned too. There's so much to be concerned about. However, that said and done, perhaps we're old school. Perhaps this is the new way forward. Perhaps they've been pioneers in that. And good luck to the founders of Afterpay. 7 years in business, they're now billionaires after creating something where there is demand and we're able to fly under the regulator's radar of not having to have a credit license in the financial services space. So they've done incredibly well. Good luck to them. Good luck to the future prospects of the business and the overall now merged entity. But, it just reeks of craziness, doesn't it? But, let's see what unfolds in the future for them.
Capital management has been a key theme during this reporting season, especially across the banks, where we expect Commonwealth Bank to announce a share buyback following similar events from National Australia Bank and ANZ as well. So the key question for investors this week is, what is the benefit of a share buyback compared to dividend payments? So a share buyback occurs when the issuing company buys back shares from investors at market value and reduces its shares on issue. This in turn can improve return on equity and boost earnings per share growth as well. For example, Tim, with the banks, they have been offloading assets over the last couple of years, and now they have excess capital on their balance sheet, don't they?
Yeah, and who would have thought a few years ago on the back of the Royal Commission when capital adequacies had to be achieved, and they've obviously done that and done it really well. So good on the banks for being able to do that. But and what it is, a beautiful thing is if they know that there's no logical acquisitions that are really smart bolt-ons to their businesses available, then let's use some of that capital in regard to a share buyback. And that's a wonderful thing for shareholders because, as you say, Kien, it makes the businesses more attractive, especially under our Golden Rule 2 criteria, being return on equity, earnings per share and the like. It makes them all look better, so they become even more attractive, and it actually increases the dividend yield, which is why most of our investors like to invest in the banks, of course. So it's a really smart move by the banks, makes a lot of sense. And as I said, very, very attractive to existing shareholders.
And thanks, Tim. Again, it's a pleasure to have you on board and for sharing your insights today.
Oh, I love it, Kien, and I love sharing what we do with our members and giving them a hand on certain things that they might sit there and wonder how to apply certain elements of our philosophies with Stock Doctor. So now, wonderful always sitting down and doing that. Obviously, a really important time of year right now. We're on the eve of reporting season, or it actually just has begun. So really important time of year for our members to be auditing their portfolios, making really smart, disciplined decisions around the construction and optimization of their portfolios relative to their objectives, keep blocking out the noise, and make hay while the sun's shining in this low interest rate environment, Kien.
Yeah, that's right, Tim. And use the power of Stock Doctor. Be wary of those speculative investments, especially with the easy money now. That's not going to last forever as well. And we've seen companies with weak financial health and a lack of earnings, for instance, trading at significant valuation multiples. But be wary of these investments, because for every company like Afterpay, there are many more disappointments as well. So have a happy, healthy, and prosperous week, everyone.